There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We got a trader on the line, and that trader would be Vlad Karpel. He is the founder of Tradespoon. Vlad, how you doing this morning?
I'm doing great. How you doing?
Doing good here on this Monday morning. A little bit of a rough weekend, but the Tigers pulled it out for me yesterday, so I'm okay on the sports front. But how about this ramp up in volatility here over the past week or so?
Yes, the market is getting volatile, and for a lot of traders, it's great news.
And so
especially for a larger hedge funds.
So they say when volatility is high, it's a good time to be out there selling options, taking in all that premium. And when volatility is low, it's time to go. Are you out there selling some of this higher beta, higher volatility stocks and options?
Yes, we're definitely looking, especially in the indexes, NASDAQ and SPX, spiders. If you look at the one standard deviation out, you can sell premium on calls and puts and do kind of a counter strategy. But I think if you look at the probability, particularly on probabilities, you get a lot of premium selling out of the money options. Whether it's S&P puts, you can go to 1900 level and sell puts. So unless market sells off another 5%, you can make money by selling those out of the money puts and calls.
Okay, and do you do
so
those?
It's kind of been our strategy.
Yeah, selling short strangle. So that's what you're doing here. You think that despite the volatility here coming off the 2000 level, back down to the mid 1950s, probably under 1950 today, we're just going to stay range bound here, maybe between 1900 and 2000 because that's really what you option sellers need is, the market to stay in a defined range. And after such a huge run up, don't you see a higher probability of, like Dennis mentioned, it's been, I think over 1,000 trading days over without a 10% correction. You expect the market to stay range bound?
I think so, especially as we approach in the earnings season, which will start on October 8th, and will kick off the earnings season. I don't think we're gonna break the trend, but you have to stay on your toes. And if earnings miss the estimates, and as we get into the earnings season, then we might get an additional volatility, and that range bound trading might change. Because if you do look at the SPX, it's been trading in a channel for the past 12 months. And as we approach in 70-day moving averages, I think we broke 50-day moving average. We settled above 50-day moving average. Friday, we're going to open on below the 50-day moving average. But if we're going to break on the downside 70-day moving average or 100-day moving average, and I think there will be an additional 5% correction, and that trend will be broken. So I would say the earnings season I think is the main decisive factor. So you want to make sure you hedge your portfolio, and even if you sell the money.
We seem to be having a little bit of technical difficulty here with Vlad here. Joe, anything on your end there?
Can you hear me?
I can hear you now. We lost you for a second. Go ahead.
Oh, sorry. Yeah. So So we kind of trading in this range-bound trading, and I think earnings season will be a decisive factor in terms of whether we're going to break this trend or not. We're going to open on the 50 days moving average or right below 50 days moving average, and as we get into the earnings season in the next couple of weeks, that will decide if the trend will be broken or not. But we believe that we are going to be in the range-bound trading, and earnings season will probably meet the analyst expectations.
So when you're talking about the moving averages, are you waiting for a close below the moving averages, or if it nicks it intraday? I mean, the moving averages obviously are a lagging indicator. So do you wait? You wait for the close, or do you start? Do you follow an intraday, and if it's breached intraday, then it will spring you into action?
Usually we're looking at the close, and we're looking at least a couple of days to continue the trend. If it breaks on the downside to the range for a couple of days, especially on above average volume, then we would decide that the trend is broken. But we're usually looking at the close, and we're usually looking at, I think for the past 12 months, when we had 2 to 3% correction, the S&P would close right around 70 days moving average or 100-day moving averages. So those are the two critical points where you want to kind of keep your eye. And if we are definitely break the 70 to or 100-day moving average, then I think the next support will be the 200-day moving averages. So you got to make sure that you just look at the volume and look at the close price.
I don't hear a lot of people talk about the 70-day moving average. I hear about the 50 and 100 and 200-day moving average. Is that something you kind of coined on your own, or did you pick up from somebody else?
Investors Business Daily, if you look at their
All
program,
right.
they are usually...
Okay.
Go ahead.
All right. Well, you're all set to trade some Alibaba options.
That has been volatile. It's one of the biggest IPOs. So, yeah, selling out of the money options. So definitely is a strategy. You probably don't want to go strangle. You probably want to do a counter and make sure you hedge yourself. And doing like third width of the strike prices is great. So if you're selling a $5 spread, then you want to get at least $1.50 of credit. If you do it on both sides, the calls and puts, I think that's a great strategy because there will be a lot of volatility, especially in the small cap stocks.
Okay, and so if you do that second strategy you talked about, you are limiting your losses then, correct? If you're doing short strangle, you short iron condor, you are limiting your losses then, correct?
Correct. You're limiting your upside, but you're also limiting your loss in case you are wrong. Because especially in this heightened volatility time period, there might be a sell-off beyond 2 to 3%. So you want to make sure that you either limit it with the size, don't trade a lot of contracts, and make sure that if you are wrong, you're only going to lose, anywhere from 3 to 5% of your portfolio, or you limit it with the hedging and doing the spreads.
Okay, we got to talk about Apple here. Bengate seems to be subsiding a little bit. The stock has been pretty volatile since it had that presentation with the iWatch and the iMoney or iPay or what is it? What do they call it? Apple Pay. Big kind of range bound here between 98 and 102, 103. Any preferred strategies with Apple?
Yes, we look at both fundamental and technical analysis at Tradespoon, and we rank our stocks. And Apple actually, on a scale of 1 through 10, where we combine long-term technical fundamental analysis, Apple has been 10 for the past couple of months on our using our quant model strategies. So we've been, since volatility is kind of low, we were doing a debit spread. So we would buy 97.5 and sell 100 debit spread. You do calls. So you do kind of in the money call spread. You can still get 30% of the width of the strike prices, and you're reducing your cost basis because instead of buying Apple at 100, you can buy it at reduced cost basis by doing this in the money call spread. Another strategy that we have been advocating is doing the calendar spreads, especially as we approach in the earnings season. You can sell 97.5 put in October and buy 97.5 put in November, with the idea that as we approach in the earnings season, the October strike price will expire worthless, and November, as implied volatility expands, you can actually make money even if the Apple stays in that range-bound trading.
So you're not worried. I mean, just think about it. When this stock got up in 2012, it got up over the $700 level, got to 705, and then boom, we all know what happened after that. Now the stock hits, 103.74, which equates out to like 726.18. And now you're back down under that old break, that former old-time high. Any worries here that this stock is going to pull a repeat of 2012, 2013?
We usually look at the momentum, and we're looking at the earnings consistency. Apple has beat earnings estimates for the past 2 quarters. So there's definitely, it all depends on the earnings. If they miss the earnings estimates, then the Apple will sell off. But we believe with the product launch and the huge lines, people getting excited about the new iPhone and bigger resolution, bigger screens, I think there is a demand. and what did they sell? 10 million iPhones in the
Right.
first week.
Yep. Yep.
Yeah, so I think that momentum will carry through the earnings season. But again, always hedge yourself and doing kind of at the money call spread. If you allocate only 2 to 3% of your money, and Apple will stay above 97.5, then you, and also limiting your downside by only paying the debit of the either the calendar spread or the vertical call spread.
All right, Vlad, I can't shake you off following the earnings. Good fundamental analysis there. Mixed in with the technical analysis that you like to follow with the moving averages. So you're sticking to your rules, Vlad. We appreciate your input here on Benzinga's Pre-Market Prep, brought to you by Charles Schwab. We'll keep an eye on the markets and hope to have you back again soon.
Thanks for having me on the show. Look forward to our next meeting.
Okay. Talk to you soon.
Take care. Thanks.